Welcome to our next reading on inventories. So we're talking about our raw materials, our finished goods and our work in progress. Okay, so if we were looking at a basic company, a merchandising company that simply bought in goods and sold them, then our inventory equations would be beginning inventories plus purchases being the available for sale goods minus cost of goods sold, representing the goods we've actually sold, equals our ending inventory. Or as we see it in the income statement, beginning inventory plus purchases, the available for sale, subtract what we haven't yet sold, the ending inventory, and that gives us our cost of goods sold. Now, why are we applying this? We're applying it because we're applying the matching concept, one of our accruals concept. What we want to make sure is that our cost of sales, otherwise known as cost of goods sold, matches the number of units we've actually physically sold. So we take our beginning inventory, add on the purchases that we've made in the year, that gives us the total number of units available for sale. If we haven't sold all of those, we're then going to subtract the ending inventory. We're taking this ending inventory out of our income statement and storing it in current assets in the balance sheet because we're saying these haven't been sold yet, they shouldn't be in the income statement. And that will take us down to our cost of goods sold, or our cost of sales, representing the cost of the units that we actually physically have sold. So we're trying to match the cost of goods sold to the number of units actually sold. Okay, our first little LOS asks us to distinguish between costs included in inventory and costs recognized as expense. Now you can see product costs are capitalized as inventory. The basic rule here is we can include all of the costs in getting our inventory into its current location and condition. So we'll include the purchase cost of any materials, less any discounts and rebates that we receive, the conversion cost of converting our materials into goods, so labour and manufacturing overheads, and any other cost necessary to bring the inventory to its present location. So all costs involved in bringing the inventory to its current condition and current location can be included in our inventory figure. Now, period costs are ones that are going to hit the income statement rather than being included in inventory. Abnormal waste. So in other words, when we look at our material and our labour, it should be based on the standard cost of production. Any overruns are deemed to be abnormal and should be expensed. Storage costs. Well, storage of our finished goods. Again, storage of our finished goods wouldn't be included. It would be in our sales, general and admin, because our cost of goods sold should only include the cost of manufacturing, producing your goods, essentially not storing them. Okay. So storage costs wouldn't be included unless they were required production costs. And then finally, selling and administrative costs, of course, again, have nothing to do with getting your goods into their finished state, so again would be expensed. Let's have a little look at an example. So in our particular company, we've produced 1,500 units. We've incurred $10 million worth of cost on raw material. Our labour costs $5.3 million. The manufacturing overhead for the year, $2.7 million. Freight into plant, cost of getting the materials into our warehouse, $150,000. Storage cost of finished goods, $375,000. Abnormal waste on material overruns, $200,000. And then some administration costs here of $190,000. So what we've been asked to do here is to work out the standard cost of one unit. So what we're going to do is take our materials, because of course they're involved in getting the stock into its current location and condition. Labour cost, because of course that's involved in producing our finished goods. The manufacturing overhead, and notice labour cost and manufacturing overhead we refer to as our conversion costs. So as long as they're the standardised amounts and don't include any overruns, then they can be included. Now remember, we can include any costs of getting our inventory into its current location and condition. So any freight in, any cost of receiving the materials into your plant can be included. Now notice the cost that we've excluded. We've excluded the storage cost of finished goods. No, it's only the cost of getting your goods into the current condition and location. Any further storage costs are excluded, so we won't include the $375,000. Abnormal wastage. Again, no, we should only be including the standard cost of producing our inventory, so therefore the abnormal cost is ignored. And administrative costs, no. Our manufacturing overhead would include all of the overheads related to production, such as the electricity for the machines, the depreciation of machines, etc. Okay. Any administration overheads, anything to do with the daily running of the business, but not directly related to production, cannot be included. So if we add up our costs, 10 million, 5.3 million, 2.7 million and 150,000, we get a total cost of our inventory of 18.15 million. Divide that through by the number of units you've actually produced in the year, 1.5 million, and we get our standard cost per unit to be $12.10. Now, our next LOS asks us to describe the methods of valuing our ending inventory. What it's asking us to do here is describe the cost formula. And essentially, there are going to be three major methods we could use: FIFO, LIFO, and average cost. And we use those to compute cost of goods sold and ending inventory. Just note that, again, there is a little video here in the Swayzer library covering FIFO, LIFO, and average cost for you. Okay. So here are four major methods. Okay, so there's an extra method here called specific identification. Let's start off with FIFO. First in, first out is what FIFO stands for. The first goods that entered your warehouse were the first goods that you sold. In other words, it's assuming that you've sold the oldest items first, and as a result, your ending inventory must contain the most recent purchases. And assuming that we live in an inflationary world, those most recent purchases will be at higher prices, so under FIFO, we'll get the highest ending inventory figure. Now, conversely, if ending inventory contains the most recent purchases, cost of goods sold must contain the older purchases, and in an inflationary world, therefore, they'll be at lower figure, so you'll get a lower cost of goods sold figure. LIFO. Now, notice it says no IFRS, so LIFO is prohibited under international accounting standards. LIFO stands for last in, first out. Basic idea here is the last goods that entered our warehouse were the first that we sold. In other words, we've sold the most recent purchases first, and as a result, our ending inventory must be made up of the oldest purchases. So in an inflationary world, if our ending inventory is made up of the oldest purchases, that must mean it contains the lowest purchases, the lowest purchase prices, and as a result, we'll get the lowest ending inventory under LIFO. However, if we've sold the most recent purchases at higher prices, it means our cost of goods sold will be higher. Now, AVCO, or average cost, says I've got no idea whether I've sold old or new items. They all look the same. So what we're going to try and do is work out a standard cost, if you like. What we do is we take our beginning inventory plus our purchases, and we divide through by the number of units represented there. And then we're going to value our ending inventory at that standard cost and our cost of goods sold at that standard cost. Because you're essentially valuing at an average cost of your purchases during the year, your ending inventory and your cost of goods sold should always be somewhere between FIFO and LIFO. Specific identification. This tends to get used for companies that maybe have inventory of very different items. So maybe you're a bespoke yacht manufacturer and you build boats to customers' specific requirements. Well, in which case each boat would be different, so you'd want to actually allocate the specific cost to each boat in your ending inventory. Or maybe very, very high value items. So maybe a diamond merchant, again, would want to allocate the actual cost of each item contained in their ending inventory. So you'd want to put in each diamond's actual price that you paid to acquire it. So that's our specific identification. Ending inventory actually includes the cost of the specific items included within that ending inventory. Okay, now our LOS says calculate costs of goods sold and ending inventory under each of our major methods, so our FIFO, LIFO and our average cost. So let's take a very simple example to start with. Let's imagine that we've got beginning inventory of one unit costing $10. During the period we purchased two more units. First purchase was at $12, second was at $14 and one unit was sold for $17. So therefore, our ending inventory must represent 2 units, because essentially we had one and we bought 2 extras, so we had 3 units, we sold one, and as a result we've got 2 left in ending inventory. So let's have a look at our methods. So first of all, our revenue. Well, our revenue should be pretty much the same under all 3 methods. It should just be the unit that we sold times the selling price, which was $17. In it goes, there's our $17 for FIFO. Now, under FIFO, of course, the cost of goods sold will represent the oldest purchases. So we've sold one unit, it will come from our oldest purchases, and that was the beginning inventory, and hence it would be valued at $10. Now our ending inventory under FIFO will be the most recent purchases. So those are the purchases at $12 and $14, so we'd value our ending inventory at $16. So notice you get a gross profit under FIFO of 7. Let's have a look at average cost. Again, the revenue is going to be the same under all three methods, so $17. Now this time we need to work out the average cost per unit. In order to do that, we take the beginning inventory plus our purchases. So $10 plus $12 plus $14, so that's going to give us $36. And we then divide that by 3, the number of units essentially that it represents, to get an average cost per unit. So 10 plus 12 plus 14, divide by 3, we've got an average cost per unit essentially of, oops, let's get the right colour, of $12. And we'll value our cost of goods sold at that. So 1 unit sold, 1 times 12, gives us a cost of goods sold of 12. So 17 minus 12, notice our gross profit is 5. Our ending inventory represents 2 units, so 2 units at the average cost of 12 gives us 24. Okay, now let's finish this off with LIFO, last in, first out. Remember, with last in, first out, you sold the most recent purchases first, so our cost of goods sold is going to contain the most recent purchase, and that was at $14. So you can see 17 minus 14 giving us a gross profit of 3, and it means our ending inventory is made up of the 2 earliest purchases, the beginning inventory and the purchase at 12, giving us $22. Okay, inventory cost flow and price changes is our next little LOS here. So FIFO, we argue that FIFO gives you an artificially low value for cost of goods sold. Now again, let's just put a caveat on that. We are assuming prices are rising, so we're living in an inflationary world for our purchases. Okay. Now FIFO gives you an artificially low value for your cost of goods sold. Why? Because the cost of goods sold contains all of the oldest purchases. Okay. Now if we were to use LIFO in the income statement, it means the cost of goods sold would contain the most recent purchases and be therefore closer to current cost or replacement cost. So the basic rule is we would prefer to see LIFO used in the income statement. Now when we look at our balance sheet, so that's our income statement, when we look at our balance sheet, it's the other way around. If we use LIFO in our balance sheet to value our ending inventory, then our ending inventory reflects the oldest purchases. And those oldest purchases are out of date, of course. We'd prefer to use FIFO because then the ending inventory contains the most recent purchases, which is closer to replacement cost, i.e. the true economic value of your ending inventory. So the basic rule here is we'd rather have LIFO in the income statement and FIFO in the balance sheet. Notice when prices are declining, the reverse would be true. If you were to have stable prices, i.e. no inflation at all in your purchase prices, then FIFO, LIFO and average cost would give you exactly the same cost of goods sold figure and exactly the same ending inventory figure. Let's talk about our inventory systems now. And our LOS here asks us to calculate ending inventory and cost of goods sold under periodic inventory systems, and actually that's what we just did in the last example, but also perpetual inventory systems. Okay, now let's talk about our periodic first. Inventory and cost of goods sold are determined at the end of the period, normally at the end of the year. So what we have in our income statement is beginning inventory, we add on the purchases we made in the year, and we then subtract the ending inventory representing the inventory we've not yet sold to get our cost of goods sold. Now in a perpetual system, inventory and cost of goods sold are continuously updated as each sale occurs. So you don't have any purchases account. Essentially what happens is when you make a purchase, it's stored as inventory in the balance sheet. So when you make a purchase, up goes inventory in the balance sheet. Oops. Let me try and write inventory so it's vaguely coherent. So you have it as inventory in the balance sheet. As soon as you make a sale, you take it out of inventory. So when you make a sale, you reduce inventory and you increase your cost of goods sold by the same amount. Okay, so it's a perpetual system. Every time we make a sale, we're taking something out of our ending inventory and putting it into cost of goods sold. Every time we make a purchase, essentially down goes our cash, up goes our inventory. So we don't need any purchase account in the income statement. What we're doing is we're monitoring our cost of goods sold as we make each sale. Okay, we're going to go on to an example because it does ask us to calculate. So we're going to use the following to calculate cost of goods sold and ending inventory under FIFO and LIFO for March. First of all, we're going to go periodic and then we're going to go perpetual and see whether we get any differences. So notice we've got a beginning inventory of 4 units at $3 per unit, so of $12. Then on the 14th of March, we make a sale. Okay. Then on the 25th of March, we make some more purchases of 10 units. And then on the 28th, again, we make another sale of 8 units. So our total inventory over the period for the beginning inventory plus the purchases equals 10 units. No, it doesn't. 4 plus 10 generally equals 14, doesn't it? Let's go again. Let's try again. Basic arithmetic, 14 units, essentially. And of course, our sales, 3 plus 8 equals 11. So our ending inventory that we're going to have under this method is going to be 3 units. Okay, now what we're going to do is look at the perpetual system and the periodic system. Let's kick off with our periodic system. Let me just get rid of that. Okay, so we're going to start off with our periodic system. And you can see our ending inventory equals 3 units. So here we go, periodic. Beginning inventory was 12 units, 4 times 3, giving us $12. We made 10 purchases in the year at $3.70, so 10 times $3.70 gives us 37. And under FIFO, first in, first out, our ending inventory would be 3 units valued at the most recent purchase prices, and that, of course, was those 10 units bought at $3.70. So 3 units at $3.70, giving us $11.10. Now, let's look at the perpetual system. We make a sale on the 14th of March, and that sale was 3 units. Okay. Now, those 3 units, of course, have got to come out of your beginning inventory because you only had 4 units at that time. So we'll value those 3 units from your beginning inventory at $3. Bang. You've then got another sale on the 28th of March, 8 units. And remember, under FIFO, we're selling the oldest units first. So we've got 1 unit of beginning inventory left. So we'll do 1 times 3. The remaining 7 units of sales must have come from our most recent purchases at $3.70, giving us a cost of goods sold of $28.90. Notice, therefore, if you add up your 2 sales, 9 and $28.90, you get an overall cost of goods sold of $37.90. The key thing to notice, therefore, is it's the same result under the periodic and the perpetual. And our ending inventory, of course, is going to be the same. Our ending inventory, you can see under the perpetual, we've got 3 units left, and they're the most recent purchases. 11.10 is exactly the same as what we had under the periodic. So, you can see you get exactly the same results under periodic and perpetual if you're using FIFO. Now, of course, what we're again going to do is have a look at LIFO, and the key that we're going to see under LIFO is we do not get the same results. So here's our data again. It's exactly the same. Notice beginning inventory 4 units, purchases 10 units, 14 units. We then sell 11 units, giving us 3 units remaining. But, of course, LIFO assumes you sell the most recent purchases first. So, under periodic, the last 11 units purchased are sold. Okay, so under our periodic convention, of course, all we're going to do is value our ending inventory at the oldest prices. Okay, now under the perpetual system, this is where it's going to get exciting. 3 of the units sold. These units here, of course. Remember, we're going to assume we sell the most recent items first. But on the 14th of March, these 4 units were the most recent purchases. So we're going to have to value those at $3. Okay. Then when we make the next sale of 8 units, 1 unit of that has got to come out of our beginning inventory. The remaining 7 units have got to come from our purchases on the 25th of March. So it's going to be more interesting. Let's have a look at how it actually plays out. Under periodic, beginning inventory 4 units at $3.12, purchases 10 units at $3.70, 37. The ending inventory, therefore, is the oldest items, so 3 units at $3, giving us $9 and a cost of goods sold of $40, therefore. 12 plus 37 less 9. Now let's look at the perpetual. This is where it differs. Because remember, on that 14th of March sale, the most recent purchases were the beginning inventory, so therefore we're using the $3. Now on the 28th of March, of course, then we're going to sell 8 units, and they're going to come out of our most recent purchases, and they're going to come out of those 10 units at 370. So we'd use 8 units times 370, 2960, giving us a cost of goods sold of 3860. What would our ending inventory represent? Well, we've got 1 unit of beginning inventory left at $3 and 2 units of those purchases at $3.70. So 1 plus times 3, 2 times 370, we'd get an ending inventory of 1040. Again, the key thing therefore to note on this one is we get very different results on using periodic and perpetual if we are using LIFO. Okay, so again, all we've got here is the three bits together, so we can just compare them. FIFO, LIFO, and FIFO inventory and LIFO inventory. First things first to notice is FIFO cost of goods sold and FIFO ending inventory are the same under periodic and perpetual. However, under LIFO cost of goods sold and LIFO ending inventory, they are not the same between periodic and perpetual. Okay, so the inventory system that you use only affects LIFO and average cost methods. It does not affect FIFO. FIFO and specific identification would be unaffected. Okay, the FIFO and LIFO relationships remain. Indeed they do. Okay, so compare and contrast the impact on the accounts of the method that we use. So let's compare LIFO and FIFO. In our income statement, LIFO, of course, would give you a higher cost of goods sold figure because it contains the most recent purchases. FIFO would give you the lowest cost of goods sold figure, of course, because it contains the oldest purchases. So again, we are assuming inflation in our purchase prices. Under LIFO, if you have a higher cost of goods sold, you're going to get a lower gross profit, lower earnings before tax, and therefore if your earnings before tax are lower, your taxes will be lower. What I should point out here is, under US tax laws, whatever method you use in your accounts, you also have to use in your tax returns. So if you've used LIFO in your accounts, you must use LIFO in your tax returns. If you use FIFO in your accounts, you must use FIFO in your tax returns. Okay, so because our earnings before tax under LIFO are lower, our taxes are lower, and ultimately our net income is lower. Look at FIFO though, lower cost of goods sold because your ending inventory is higher essentially. Lower cost of goods sold gives you higher gross profit, higher earning before tax, higher taxes and higher net income. Let's think about the balance sheet. Under LIFO, your ending inventory of course is the oldest purchases and as a result will be valued lower. Compared to FIFO where your ending inventory contains the most recent purchases and hence will be valued at a higher figure. Working capital, and if we just assume our working capital is current assets minus current liabilities, well of course, if ending inventory is a current asset, under LIFO you get a lower figure, so you get lower working capital. Under FIFO your ending inventory is higher, so your current assets are higher. Current liabilities of course are unaffected. Retained earnings, RE, retained earnings, well again if you think about net income back up here, essentially, lower net income under LIFO, lower retained earnings, because remember your net income, net of dividend, is transferred into retained earnings. FIFO, higher net income, and as a result, higher retained earnings. And then finally our cash flows, notice they're higher under LIFO and lower under FIFO. The only reason for that is tax. Okay, if it wasn't for tax, you'd give exactly the same cash flows. It's literally because under FIFO, if we choose to use FIFO in our accounts, we have to use it in our tax returns. As a result, we'll have more profit that's taxable and we'll pay more tax, giving us a lower cash flow from operations. Right, pushing on, our next LOS asks us to discuss the lower of cost and net realizable value. So we're going to look at inventory valuation under IFRS first of all. And IFRS says you must value your ending inventory at the lower of cost and net realizable value. Now we've already talked about cost. It's the cost of bringing your inventory to its current location and condition. It's the standard cost, remember, ignoring abnormal amounts, storage costs, admin overheads, selling costs, etc., etc. So the standard cost of producing your ending inventory. Now, as long as net realizable value is above the standard cost of producing your ending inventory, then we'll just see it valued at cost in the balance sheet. However, we do have an issue if net realizable value falls below our standard cost. So what is net realizable value? Well, essentially, it's estimated selling price less any cost of completion. Well, this, of course, is only going to be relevant if you're looking at work in progress. Oops. If you're looking at your work in progress, because there's still costs of completing the goods. If you're looking at finished goods, then you won't have any estimated cost of completion. So basically, if we were looking at a finished good, net realizable value would simply be estimated selling price less any selling costs, any costs you're going to incur in selling the goods to get your net realizable value. If net realizable value falls below cost, you have to write it down to the net realizable value. So down comes ending inventory in the balance sheet. The other side, it appears as an expense in the income statement in your unusual or infrequent items. Now, if net realizable value then recovers in a future period, you can reverse the write down, okay? So you can write the ending inventory back up in the balance sheet and reverse the write down, show it as essentially a revenue in the income statement, increasing your net income. So note, IFRS does allow us to reverse write downs of inventory. Let's look at US GAAP. It's a similar rule to IFRS, but not quite the same. US GAAP uses the law of cost and market value. Now, cost is the same as IFRS. It's the standard cost of getting your goods into their current location and condition. Market value is slightly different though. Market value is going to be the replacement cost, the cost of replacing your ending inventory. But that replacement cost is subject to an upper and a lower limit. The upper limit is net realizable value, calculated just as we did for IFRS, i.e. selling price less any additional selling costs. Okay, so in other words, if replacement cost is above net realizable value, we'll just use net realizable value. There's also a lower limit, and the lower limit is net realizable value minus your standard profit margin. Again, if replacement cost is below this, we'll use NRV minus normal profit margin. So essentially, replacement cost is only used if it is between those upper and lower limits. But again, if your market value has fallen below cost, then you have the write down. Write it down to market value in the balance sheet. Show the write down as an unusual or infrequent item in your income statement as an expense, reducing net income. Now again, note with US GAAP, once you write down your ending inventory, you're not allowed to reverse that even if market value recovers in a subsequent period. So under IFRS and US GAAP, reporting inventory above cost is allowed, but only for certain industries. So it's very, very rare, essentially. Notice it tends to be producers and dealers of commodity-based products, things like, oil, gold, that kind of stuff. In that scenario, you can report the inventory in your balance sheet at its realizable value rather than cost. Okay. Now, if there's an active market for this product, then essentially we just use the quoted market price as the estimate of realizable value. Okay. So what it is, it's a bit like the treatment of a trading security that we talked about earlier. Essentially, you're marking your inventory to fair value. Any unrealized gain or loss that you make is taken to the income statement. So even though you haven't sold the ending inventory yet, the unrealized gain and loss as a result of marking to market hits your income statement. Bit of an odd one, but just be a little bit aware of it. Next, LOS asks us to describe the disclosures for inventory. Now, of course, one thing the analyst needs to know is what method have we used? Have we used LIFO? Have we used FIFO? Have we used AVCO, for example? So number one, the cost flow method used to value your ending inventory has to be disclosed in the footnotes. Next thing, the carrying value of inventory in total and by classification. And note, when we say classification, we're splitting into its three types: raw materials, finished goods, and work in progress. Remember what work in progress is? It's where we've started to manufacture a good at the year end but have not yet completed it. Okay, now, also we need to show the carrying value of any inventory reported at fair value less selling cost. Okay, so remember, if we've got write-downs and we've taken fair value less selling cost and net realizable value, then we need to show the total amount of inventory that is shown at net realizable value rather than historic cost. We also have to show the cost of goods sold for the period. Remember, on the income statement, you don't have to split sales, general and admin and costs of goods sold out. You can just show it in one line, operating expenditure. Now, if you do show it in one line, then you're going to have to separately disclose your cost of goods sold in the footnotes. The amount of any inventory write-downs for the period is going to need to be disclosed, and the amount of any reversals of past write-downs. Now, of course, that's IFRS only because you can't reverse write-downs under US GAAP. And then finally, the carrying value of any pledged inventory. This is essentially if you use your inventory as security on loans that you've taken out. Our last little LOS in this particular area asks us to calculate and interpret inventory-based ratios. Now, first of all, let's think about our profitability ratios. Now, as compared to FIFO, LIFO is a better measure of economic cost in the income statement, because if we use LIFO in the income statement, our cost of goods sold contains the most recent purchase prices, and that we like. So LIFO will give you a higher cost of goods sold because it contains the most recent purchase prices. Higher cost of goods sold is going to give you a lower gross profit margin. Remember, gross profit is just sales minus cost of goods sold. Gross profit margin, therefore, is gross profit divided by sales. A lower operating profit, and of course, operating profit is EBIT generally. Again, it should really only be the returns that you make from your day-to-day business activities. Actually, EBIT includes things like other income as well. But often we use EBIT as a proxy for operating income. So operating profit margin is simply EBIT over sales. And then finally, net profit margin, which is net income over sales. So if you have a higher cost of goods sold figure, your margins are going to be lower. Now let's think about our liquidity ratios. So our liquidity ratios typically are the current ratio, the cash ratio, etc. The acid test ratio as well. So essentially these are balance sheet based measures. Now the general rule, remember, is we like FIFO in the balance sheet because it means if we use FIFO, it means the ending inventory contains the most recent purchase prices and as a result is closer to replacement cost or economic value. So FIFO would give you the higher ending inventory, which means it would give you the highest current ratio. Remember your current ratio, current assets over current liabilities. Would it affect the quick ratio? Quick ratio, current assets excluding inventory? So no. Quick ratio and cash ratio, of course, are not affected by your inventory method because they don't include inventory in their measure of current assets. Working capital, remember we said current assets minus current liabilities. Well, if FIFO gives you higher ending inventory, it's going to give you higher current assets and as a result, higher working capital. Activity-based ratios. So our activity-based ratios are mixed ratios where part of it's coming from the balance sheet, part of it coming from the income statement. LIFO cost of goods sold, of course, is based on the most recent purchase prices, but LIFO ending inventory would be based on historic prices. So if we look at inventory turnover, which essentially is cost of goods sold divided by average inventory. Now note, of course, we use average inventory because cost of goods sold comes from the income statement. As a result, it's spread over an entire year, whereas the balance sheet's static at a point in time. So it's best to use average inventory, which is just last year's inventory figure plus this year's inventory figure divided by 2. Anyway, if you use LIFO to value your ending inventory, you're going to get lower inventory. So the idea essentially is if we've used LIFO, we've got higher COGS but lower inventory, and as a result, we'll get a higher inventory turnover ratio. Now, if we've got a higher inventory turnover ratio, we're going to get lower days of inventory on hand. Remember, days of inventory on hand is just 365 divided by your inventory turnover. Okay, so because your inventory turnover is higher, you're going to get lower days of inventory on hand. Let me remind you roughly of what days of inventory on hand is. It's telling us the time between receiving raw materials and selling finished goods. Leverage ratios. Let's think about our leverage ratio. Now FIFO, of course, results in higher assets because it gives you higher ending inventory because they're at the most recent purchase prices. So again, all of this is assuming inflation in your purchase prices. Now FIFO, of course, also would give you higher stockholders' equity. Why higher stockholders' equity? Well, remember, it gives you lower cost of goods sold in the income statement, lower cost of goods sold, higher taxes, but also higher net income. And if we have higher net income, we have higher retained earnings. And if we have higher retained earnings, of course, we have higher equity. So let's think about those. If we use FIFO, our assets will be higher. Now debt, I should say, is unaffected by either method. So debt is not going to be affected, but FIFO is going to give us higher assets and as a result a lower debt to asset ratio. Of course, FIFO gives us higher retained earnings and hence higher stockholders' equity, so a lower debt to equity ratio. So notice therefore that FIFO is generally going to be good for our leverage ratios. Just a few other little ratios just to remind yourselves, we talked about these anyway. The inventory turnover ratio, cost of goods sold over average inventory. Remember, whenever you're looking at a mixed ratio, use averages of the balance sheet. Mixed just means part of it's coming from the income statement, part from the balance sheet. Days of inventory on hand, remember 365 divided by inventory turnover, the time between receiving raw materials and selling finished goods. And our gross profit margin, gross profit over revenue, where gross profit essentially, and revenue they mean sales really, is sales minus your cost of goods sold. Okay, inventory management, in other words, warning signs and things that the analyst should be looking for. So they say, well, what about low inventory turnover? So the days of inventory on hand is very, very high. Now, if days of inventory are very, very high, it could indicate that you are having problems selling your ending inventory. And if you're having a problem selling your ending inventory, it could indicate that you have obsolete inventory, in which case the analyst would be making sure that that inventory is being written down. High turnover, low days of inventory on hand with low sales growth relative to the industry. Now, essentially, if you've got low sales growth, but very small days of inventory on hand relative to the industry, it could actually indicate that you're losing sales from insufficient inventory levels. And we talk about losing sales from insufficient inventory levels as being stockouts. Okay, so your sales growth is low relative to the industry, but you're turning your inventory over very rapidly. So you've got very little inventory on hand, meaning essentially people might come and want to purchase from you, but you haven't got the inventory. High turnover, low days of inventory on hand, okay, with sales growth that is above industry average. Well, that would, of course, indicate efficient inventory management. We're making high sales, and our sales are growing at a very rapid rate, but we've got low days of inventory on hand, meaning we're holding the minimum amount of inventory that we require. So we're being very efficient. Okay, let's finish this reading with a question. For analytical purposes, an analyst would prefer to use which method? LIFO COGS, FIFO inventory? Well, remember, basically, they like LIFO in the income statement because the cost of goods sold would represent the most recent purchases, but they prefer FIFO in the balance sheet because FIFO in the balance sheet, the ending inventory would contain the most recent purchases. So therefore, our answer is A.